Something strange is happening in the global silver market, and most investors are completely unprepared. Reports from China suggest physical silver is trading near $80 per ounce today. This price is not visible on Western exchanges like COMEX or the London bullion market. Instead, it appears in real physical transactions inside China's domestic silver market. At first, analysts dismissed these numbers as rumors or misunderstanding of local pricing structures. But the premiums did not fade, and the price gap continued to widen aggressively. In commodity markets, large and persistent premiums signal one thing: physical scarcity. Silver has two prices, paper silver and physical silver, and they are no longer aligned. Paper silver trades effortlessly through futures contracts and leveraged financial instruments. Physical silver must be mined, refined, transported, and delivered to real industrial users. For decades, paper markets controlled silver price discovery across the entire global system. But when physical demand overwhelms supply, paper prices lose their authority rapidly. China is not a speculative buyer. China consumes silver for production and strategic industries. Silver powers solar panels, electric vehicles, electronics, batteries, and advanced manufacturing lines. Factories cannot wait for futures contracts. They require immediate delivery of real metal. When supply becomes uncertain, factories pay whatever price necessary to avoid shutdowns. This behavior creates extreme premiums that paper traders often fail to understand. High premiums are not bullish excitement. They are stress fractures inside the supply chain. Once premiums explode, arbitrage mechanisms begin to fail across global markets. Metal no longer flows freely from low-price regions to high-price demand centers. That breakdown is how physical squeezes quietly begin, long before prices move globally. Western markets still show silver near $30, creating a dangerous illusion of stability. But physical buyers in Asia are signaling that available supply is already tightening rapidly. COMEX inventories look large on paper, but deliverable silver is far more limited. Every ounce removed from vaults increases pressure on futures-backed price systems. When confidence in delivery weakens, paper contracts lose credibility overnight. This is how price discovery migrates from screens to warehouses and factories. Historically, silver squeezes move slowly, then violently, catching most investors off guard. By the time Western prices react, physical silver is already unobtainable. China's $80 silver may not be the future price, but it is a warning. Silver is a small market, which makes it extremely vulnerable to sudden supply shocks. Unlike gold, silver inventories are consumed permanently by industrial processes. Once silver is used in electronics or solar panels, it rarely returns to the market. This creates a structural deficit that grows quietly over many years. Global mine supply has struggled to keep pace with rising industrial demand. Many silver mines operate as byproducts of copper, zinc, and lead production. That means silver output cannot quickly increase, even when prices rise sharply. Supply remains rigid while demand continues expanding across green energy industries. China dominates solar panel manufacturing and electric vehicle battery supply chains. Every expansion in renewable infrastructure directly increases silver consumption. Western markets often underestimate how quickly industrial demand can drain inventories. When warehouses empty, price adjustments happen suddenly, not gradually. Paper markets assume liquidity that only exists during calm market conditions. Stress exposes how few contracts actually convert into physical delivery. If too many participants demand metal simultaneously, the system seizes. This is not theory. It has happened before in previous commodity squeezes. Silver's history is filled with violent repricing events triggered by physical shortages. Each event followed the same pattern: denial, disbelief, then panic. By the time panic arrives, inventory is already gone. China's pricing behavior suggests the denial phase may already be ending. Western traders still focus on charts, indicators, and paper positioning data. Meanwhile, physical buyers focus on tonnage, delivery dates, and supplier reliability. These two worlds rarely align during periods of extreme market stress. When they finally collide, prices reprice violently to reflect physical reality. Premium explosions are early signals, not late-stage reactions. Ignoring them has historically proven extremely expensive for investors. The silver market does not need universal demand to break, only concentrated urgency. China represents exactly that kind of concentrated industrial demand. Once supply tightens locally, global markets eventually feel the shockwaves. The question is not if silver reprices, but how fast the transition occurs. COMEX appears liquid until delivery requests suddenly expose how little metal is truly available. Most futures contracts are rolled forward, never demanding real silver bars. The system functions smoothly only when participants trust settlement without delivery. That trust evaporates quickly when premiums explode in physical markets elsewhere. LBMA relies on unallocated accounts backed by fractional physical inventory. In calm markets, this structure works. During stress, it becomes dangerously fragile. If even a small percentage request allocation, vault pressure escalates rapidly. Physical silver cannot be conjured instantly to meet unexpected delivery demand. When vaults strain, exchanges adjust rules instead of prices. Rule changes signal weakness, even when markets pretend everything remains normal. China's domestic market operates differently, prioritizing metal availability over financial engineering. Buyers there pay premiums not for profit, but for guaranteed supply. This creates a parallel price system disconnected from Western benchmarks. Eventually, global producers sell to whoever offers certainty, not the highest paper bid. Metal naturally migrates toward markets where delivery risk is lowest. That migration quietly drains Western vault inventories over time. Price charts remain calm while physical foundations erode beneath them. This is why squeezes feel sudden, even though they build for years. Silver's low above-ground stock makes it uniquely sensitive to industrial hoarding behavior. Once hoarding begins, available float collapses far faster than expected. Investors often underestimate how quickly sentiment shifts when delivery risk emerges. Markets move from abundance psychology to scarcity psychology almost overnight. Scarcity psychology does not negotiate, it demands immediate action. That is when price gaps form faster than arbitrage systems can respond. Arbitrage depends on transport, trust, and time, all absent during crisis. By then, premiums dictate reality, not futures prices. China's $80 silver highlights where physical stress already exists. Other regions may follow once inventories tighten further. Silver rarely signals loudly before moving. It whispers through premiums first. Those whispers are now impossible to ignore. Every major commodity squeeze begins when physical buyers stop trusting paper promises. Silver is especially vulnerable because its market is small and highly leveraged. A relatively minor disruption can cause outsized price reactions. China's pricing behavior suggests that disruption may already be underway. This is not about speculation. It is about securing survival within industrial supply chains. Factories cannot hedge shortages with charts, forecasts, or analyst opinions. They hedge shortages by paying premiums and locking in immediate delivery. When enough buyers behave this way, price discovery shifts permanently. Western markets often recognize this shift only after inventories are depleted. By then, futures prices are forced to catch up violently. History shows silver does not move smoothly during supply crises. It gaps higher, pauses briefly, then accelerates beyond expectations. Those waiting for confirmation usually receive it at far higher prices. China's $80 silver is not a forecast, but a stress signal. Stress signals appear long before headlines declare a crisis. Premium explosions are the market's early warning system. Ignoring them has never prevented a squeeze, only delayed awareness. The silver market does not need panic, only persistent delivery pressure. Once that pressure reaches Western exchanges, options disappear quickly. Metal moves first, narratives follow later. The illusion of abundance collapses faster than most investors expect. When silver reprices, It does so in days, not decades. The calm on price charts may be the most dangerous signal of all. Silence in markets often precedes violent repricing events. China may simply be revealing what global markets refuse to acknowledge. Silver is not expensive. It is becoming unavailable. Availability, not valuation, ultimately determines price. Those watching premiums understand what charts alone cannot reveal. The silver squeeze rarely announces itself clearly before it begins. By the time it does, the opportunity has already passed.